Looks full, losing fast. Over a lifetime, more than $1 million quietly disappears. And no, it's not the lattes, so what's really stealing it? Everyone blames the small stuff, but the real drains are hidden in plain sight, quiet, automatic, and compounding. 7 of them. And once you see them, you can't unsee them. I'm Oliver, and for the next 25 minutes, we're walking through all 7 together. By the end, you'll know exactly which one is quietly draining your wealth, and how to start sealing each leak. You've probably done this. Coffee, bank statement, a quiet Sunday morning. Nothing obvious jumps out, no major mistake, and yet somehow every month less is left than you expected. Your paycheck enters the funnel looking healthy, but by the time it reaches savings, it's already been filtered through forces most people feel but never stop to name. Cutting lattes feels productive, but the math barely moves. The real drains are bigger, quieter, and built into your routine. 7 of them. Let's name the first one. Here's the honest comparison. Small habits versus structural drains. One nudges the needle. The other 7 quietly reshape your entire financial life without asking for your attention. 7 doors, 7 hidden drains. Behind each one is a pattern you've probably lived through without ever giving it a name. Door number 1 is the one most people miss completely. Drain number 1 is lifestyle creep. It's the silent upgrade. Your income grows and almost every expense grows with it. 10 years later, you earn twice as much and somehow save about the same. Every raise feels like permission. A better phone, a nicer watch, a bigger car. Each upgrade seems harmless by itself. Together, they consume the raise before your future ever gets a chance to keep it.
It's the upgrade treadmill. You run faster, earn more, and somehow the wheel spins faster too. The finish line doesn't stay put. It quietly moves further away. Yesterday's luxuries become today's baseline. What felt special at 25 starts feeling necessary at 35. And that baseline, more than your income, shapes how wealthy you actually feel. The pattern is surprisingly consistent. Spending climbs steadily. Happiness rises a little, then barely moves. That gap between what costs more and what feels better is where lifestyle creep quietly lives. The fix is simpler than it sounds. Save half of every raise automatically before it touches your lifestyle. Over 20 years, that single rule can quietly transform the whole picture. One drain named, one door closed. But lifestyle creep is only the beginning. The next one is even sneakier because it takes your money without asking for your attention at all. Drain number 2 is subscription sprawl. Each one looks small. Together, they become a monthly total most people can't estimate accurately and often couldn't list from memory. Watch what happens when you actually add them up. $75 a month, $900 a year. Over decades, and especially if invested instead, that becomes real money from charges you barely notice. No single drip floods a tub, but enough of them running long enough absolutely will. That's how budgets quietly overflow, not through one dramatic choice, but through dozens of unattended ones. Here's the fix. Run a simple 90-day audit. List every recurring charge. If you haven't used it recently, cancel it. It's simple, slightly uncomfortable, and almost always worth doing. 2 drains down, but at least subscriptions are visible if you go looking. The next one is harder to notice, and it usually takes a much bigger slice.
Drain number 3 is tax inefficiency.
Taxes themselves aren't the villain, but paying more than you legally need to, year after year, is a quiet subtraction most people never challenge. 2 people can earn the same income and still keep very different amounts. The difference often isn't talent or luck. It's just that one person understood a few basic rules the other ignored. There are 3 levers most people never touch: where they hold money, when gains are realized, and how income is structured. Used legally and patiently, each one compounds over decades. 2 identical investments can end very differently depending on the account they live in. Same contribution, same return, very different outcome once taxes have had decades to take their share. Timing matters more than most people think. A few simple year-end moves, reviewed with a qualified professional, can change the tax picture meaningfully.
Not tricks, just thoughtful use of the rules. A good tax professional often pays for themselves many times over. This isn't about clever loopholes, it's about using the same legal tools more informed households have quietly used for years. There's usually an order that helps. Capture the employer match first, then work through tax-advantaged accounts. Only after that move to regular taxable investing. The order alone can change outcomes. Same paycheck, same job, two very different futures 30 years later. Sometimes the difference is just a small amount of attention paid consistently to something most people avoid thinking about. 3 drains named, but the next one compounds every single year, quietly, relentlessly, and most people don't notice until decades have already passed. Drain number 4 is fee drag. 1% sounds tiny, almost harmless, but over a lifetime of investing, that 1% can quietly rewrite what retirement looks like.
Same contributions, same market return, different fees. Over 30 years, that gap can easily grow into hundreds of thousands of dollars from what looked like a small annual difference. Most fees hide in plain sight. Expense ratios, advisory fees, trading costs, wrap fees. Each one looks manageable alone. Stacked together, they can quietly consume a huge share of long-term growth. Decades of research keep reaching a similar conclusion. Most actively managed funds don't consistently beat simple low-cost index funds after fees. Not because professionals are foolish, because fees compound too. What makes fees dangerous is that you rarely see them leave. They're deducted before you check the balance. Silent, automatic, working against you in the background every market day. 3 rules matter here. Know what you pay. Keep total costs low whenever possible, and ask what you're actually receiving for the fee. Sometimes the answer is useful, sometimes it barely exists. Same money going in, different money coming out. That's the quiet arithmetic of fees. It doesn't feel dramatic in 1 year. Over 30, it becomes transformative. One question changes a lot. What is your true all-in cost once every fee is added together? Most people can't answer it clearly. The people who can tend to keep far more of what they earn. 4 drains named, but the next one can't be canceled or avoided. It can only be understood and planned around, and even careful savers underestimated. Drain number 5 is the inflation blind spot. Your money doesn't need to visibly disappear. It only needs to stand still while everything else quietly becomes more expensive. The item didn't change. The milk is still milk, the bread is still bread, the gas is still gas. But the numbers next to them keep climbing, year after year, without asking permission. Historically, average inflation means $100 kept in cash may buy roughly half as much 30 years later. That's not drama. That's just the long math of a normal economy. Cash feels safe because the number stays still. But the number and what it can actually buy are 2 different stories. Over decades, too much idle cash becomes its own silent loss. Every year, your savings are racing inflation. If your money grows faster, you gain ground. If it grows slower, you quietly fall behind, even while the balance appears higher. Different assets interact with inflation in different ways. Cash usually loses ground. Bonds can help more modestly. Diversified ownership of productive assets has historically done better over long periods, though never smoothly. Think of inflation like a moving walkway going the wrong direction. Standing still means drifting backward. Small, steady forward steps are what keep you in place. Faster steps are what move you ahead. This is not a case against cash. You absolutely need cash for emergencies and short-term needs. The blind spot is holding far more than that for years without realizing what inflation is doing to it. A generation ago, a modest home, a family car, and education cost dramatically less than they do today. Any long-term plan has to respect that same quiet upward climb in the future. Here's the concept to remember. Real return equals what you earned minus what inflation took. If you only watch the nominal number, you're only watching half the story. 5 drains named. But the next one doesn't show up on a statement or a portfolio chart. It shows up in the choices people make at exactly the wrong emotional moments. Drain number 6 is emotional money decisions. Not stupidity, not weakness, just a very human tendency to feel first
and act before the plan gets a chance to speak.
The pattern is universal. People often sell after drops and buy after big rises. Emotion quietly guides them toward the exact opposite of what long-term discipline usually rewards. Study after study finds the same uncomfortable gap. The average investment often earns more than the average investor does, simply because behavior gets in the way. Between feeling and action, there's a tiny window, a pause, a breath. The people who protect that pause and let a written plan decide tend to do better than the people who react. A written plan becomes a shield during turbulence. Automatic investing, scheduled rebalancing, limited checking. None of it is exciting. That's exactly why it works so well. Patience is not flashy. It doesn't trend. It doesn't feel clever. But over long stretches of time, it beats brilliance more often than most people want to admit. Here's a quiet test during any emotionally charged market moment. If your long-term goals, timeline, and plan didn't actually change, the best move may be the one that looks like doing nothing. Every generation sees difficult market periods. Every generation also sees recovery and growth afterward. History never guarantees the future, but it strongly rewards calm more than panic. 6 drains named, only one left. And this one makes no visible charge at all. No fee, no tax, just a trade-off hiding inside everyday choices. Drain number 7 is opportunity cost. It's the road not taken. Every dollar spent today is a dollar that won't grow for tomorrow. Not wrong, just a future traded for a present moment. $10 spent today is a small pleasure. $10 invested for decades can become many times larger. Neither choice is automatically bad, but both are real choices, and they deserve awareness.
Every major purchase has 2 price tags, the one on the sticker and the future value that money could have become over time. Most people only notice the first. This isn't about removing joy from life. A life lived only for the future isn't a good life either. It's about seeing the trade clearly so the choice becomes intentional. One gentle question changes spending behavior. Is this purchase worth more to me than the future version of this money? Sometimes yes, sometimes no. The pause itself is what matters. Opportunity cost is the compound effect of small, repeated choices. Not dramatic, not urgent, but over thousands of decisions, it creates the difference between I could have and I did. Here's a principle that quietly builds wealth. Spend generously on what genuinely matters to you. Cut aggressively on what doesn't. Most people reverse that and then wonder where the money went. Every invested dollar is like a note to your future self. Most people never send enough of those notes. The ones who do, consistently and patiently, eventually meet a future with more options. 7 drains named, 7 doors closed. But here's what people often miss. They don't operate one by one. Together, they become something much bigger. There's one silent partner behind all 7 of these drains, and when used well, it becomes your greatest ally: time. The earlier you seal the leaks, the more time starts working for you instead. Here's a result that surprises people. Someone who starts early and contributes for fewer years can still end with more than someone who starts later and contributes much longer. That's how powerful time is. That's why now is often the best time to act, whatever age now happens to be. Not because later is hopeless, just because every extra year of compounding matters more than most people expect.
Time gives you 3 gifts: growth on growth, space to recover from setbacks, and enough repetition to slowly build better behavior. There's a saying that fits perfectly here. The best time to start was long ago. The second best time is today. It may not feel ideal, but it is still enough. Every leak you seal today is like planting a tree for your future self. You won't enjoy its full shade immediately, but one day you'll stand in a forest built from choices that once felt small. 7 drains, 1 powerful ally in time. But to really understand the picture, you have to see what happens when all 7 drains operate together. Here's the full comparison. Same person, same income, same career. The long-term difference often comes down to whether those 7 drains were noticed and addressed. These are rough educational estimates, not promises, but they illustrate the scale. Each drain alone may look manageable. All 7 working over a lifetime can easily add up to over $1 million. And here's the deeper point. These drains don't simply add together, they reinforce each other. Lifestyle creep feeds subscription sprawl. Emotional decisions amplify fee drag. Tax inefficiency deepens opportunity cost. You do not need to fix everything at once. Start with the easiest win. Close one drain, then another. Momentum matters more than perfection. 5 small actions in 1 week can often begin closing several drains at once. It won't feel dramatic immediately. That's okay. Compounding rarely does. These habits are not about restriction. They're about creating a connection between your present choices and the future version of you who will live with them.
7 drains, 1 compound system, a simple starting plan. But there's still one lesson beneath all of it that matters even more than the details. Here's the truth most finance content skips. Wealth is not mainly built by what you earn. It is protected or lost by what you notice. Attention matters more than people think. High income without awareness can produce less wealth than modest income with consistent awareness. That's the uncomfortable part. It's also the hopeful part. The key is not a bigger paycheck, not a secret investment, not a clever trick. It's the habit of noticing where your money is actually going and responding on purpose. 3 reminders are worth carrying forward. Notice the creep before it becomes normal. Count the fees before they compound. Protect your patience when the world feels loud. This is an educational framework, not personal advice. Your actual circumstances deserve thoughtful decisions and, when needed, a qualified professional. But the awareness part begins with you. 7 drains named, 1 real lesson understood, and 1 final invitation before we close. Here's what I hope stays with you. The goal is not perfect control. The goal is to stop letting important leaks run unnoticed. Awareness first, action second, patience always. If 1 month from now you've only sealed 1 drain, you're still ahead of where many people remain for years. This is not about perfection. It's about becoming slightly more aware every year. If this helped make something click, a quick like really does help more people find it. And if you want more videos like this, subscribing is the easiest way to see the next one. Next time, we'll flip the lens. This video showed what to stop. The next one will show what to start. The quiet money habits that tend to build real freedom. Take care of your future self.